welcome everyone for joining. It is 2:01. We are going to get started with today's webinar. My name is Matt Swerdlow. I'm a Director of Capital Services at Ariel Property Advisors based in New York City. I raise debt and equity capital for commercial real estate projects across the country. Today's topic is going to be how deals are getting done in the COVID-19 era. We are joined by Mark Bahiri, co-founder and managing partner of Emerald Creek Capital, a very good bridge lender in New York City. Jim Bizomo, chief underwriting counsel at AmTrust Title, and Craig Price, partner at Self-Converting Goldman. These guys are active. Their companies are the foremost of their industry. And I think we are going to get some good insight from each of them from their different disciplines. Just to set the stage a little bit, a lot has changed. February saw a big drop in rates. Everyone, it seems, was rushing to refinance their loans, break prepayment penalties, do whatever they could to kind of get. At the time, we were getting 2.5%, low 2% multifamily rates for commercial real estate refinancing, which was great. It was a boon. Fast forward a little bit into March, and things kind of got a little bit hairier as the fundamentals of the economy slowed down with unemployment, with the stay-at-home orders spreading across the country, with a lot of the political uncertainty. It kind of reverberated through the commercial real estate market. So, which it definitely directly affected acquisition. It affected financing, and it affected banks' appetites, I think, most first and foremost. Right now, there's definitely a little bit of disruption in the bank world amongst acquisitions and financing assignments. The CMBS world is on pause, kind of on a wait and see. Fannie and Freddie for the multifamily across the country are still lending, but they have some specific new conditions and hurdles that have to be met for different structures that they're originating, which we'll get into in a little bit. And pretty much we're going to speak about pretty much all those topics and more. So we're just going to dive in right now. We're going to start off with Craig. So Craig, as an attorney, I know we share some clients. I know you mentioned you have a closing next week. Have you seen loan docs, commitments have stricter language? Are there stricter recourse covenants with a little bit more teeth? Have you seen, so to speak, COVID clauses in these loan docs?
So it's interesting because thank you first for moderating.
You got it.
And for AmTrust for having us all here. It's interesting. What we found is that initially everybody sort of stopped, assessed, and now we're proceeding again. I think deals that were in the pipeline are still getting done, and we have a series of financings that we're going to get done at the end of the month. What we've seen is that depending on the lending institution, for instance, I'm doing a Freddie deal now. We had negotiated pretty much, or at application, looked at what we thought were the terms of the deal, and now we were told less than a week before that, wait a minute, we're now going to add what we'll call a COVID debt service reserve, whereby they're going to take a year reserve, put into place certain threshold items that need to take place in order for that money to be released. And I think part and parcel is that they're afraid that here they're going to make the loan, and then that borrower is going to come to them and ask them for forbearance, so that they want to have some level of protection. So what we've seen is the addition of a COVID rider, basically, that sets up a reserve that will be in place for a year at the very least, or 12 months from the effective date. And that will in turn, depending on the events that take place over the course of the next 12 months, will determine whether or not that money can be released. Obviously, that money is used in case that due to COVID-related items, that the payments need to be supplemented based on the income at the property. They set out basically a 5-pronged test as to how that money can be released. It'll have to be 12 months from it. It'll be the threshold of occupancy. It'll be what the debt service is, it will be, actually, it has to be 90, this is interesting, has to be 90 days from when the state and federal government actually have lifted basically the stay at home or the in place orders related to COVID as one thing, as one item. And once those numbers are given to the bank, they'll make the determination as to whether or not they'll release those funds. And how they can use those funds will be determined based on whether or not there's a forbearance agreement in place. If there is, all of those funds will have to get repaid first. There won't be interest on that money, but they will need to make sure that all those funds will be paid. And then once that's done, it will either go to either pay down the loan, which Freddie doesn't really allow because they don't allow partial prepayments, but it will either go towards that or it will go to a capital reserve thereafter. The one interesting piece that I've had on my deal is that it was a new building, so there was no cap reserve fund initially. So we are working, and this is where we can try to, a little squish room, if anything, is asking that as long as there's nothing, as long as we've made all those payments, that we can get that, the borrower can get those proceeds directly.
Mm-hmm. And what's the tenancy of that building? Is there any commercial tenants or is it pure multi?
In that particular property, it's pure residential, it's pure multi. So there's no retail component. The one loan that I had that was analogous to this, right after the COVID stay-at-home went into place, that loan, which was a balance sheet loan that was going to turn to Freddie, automatically was pulled. So it was interesting. That loan was lost, and the client was searching for new debt.
Yeah, I'd say, the Treasury, in conjunction with the Fed, has injected a lot of their own capital or a combination of their capital to prop up Fannie and Freddie. They're definitely, I don't want to say they're the only game in town right now. Obviously, all of us play in New York City. We're the benefit of one of the most liquid commercial real estate markets in the country. But across the country, in a secondary or tertiary market, pretty much your only outlet is going to be Fannie and Freddie. And the reason I brought up the commercial component is because, as we've all noticed, since we stay at home, we are kind of no longer consumers. We're not going to stores. We're not going to storefronts anymore. And those storefronts who have lease obligations with their landlords are having trouble trying to figure out how to pay rent without getting any sales. So Fannie and Freddie are kind of taking two different tones on that, so to speak. One is where they're not underwriting commercial income at all. And the second one is where they are underwriting commercial income if the owner or a very savvy broker can make an argument if that retail is an essential use or very high credit, right? Their bond rating. So those are pretty much two of the avenues that I know we've had success in negotiating with the agencies on how to push forward those deals. But pretty much going back from Fannie Freddie to the balance sheet world, we've definitely seen a lot of banks just put zeros in rent rolls for commercial income. If you're in the space, how big of an implication that can have on your loan sizing, especially if you're anywhere between 25-40% of your building is commercial. So that's really interesting. Mark, as a bridge lender, right? Have you seen some of these deals that, say, Freddie has passed on or other balance sheet lenders have passed on?
Yeah, I mean, it's interesting. First of all, thanks for hosting. It is interesting. We've seen an uptick in deal flow, and most of the deal flow that we're seeing are fallouts from the banks. So they're deals, they're mainly acquisition loans. They had documents issued by the lenders. Those lenders, once this crisis has hit, have put the brakes on, and so we're seeing a lot of that fallout here and there. We're interested in financing that. Now, obviously, the deals need to be structured for many of the reasons you're talking about. To the extent that there's commercial tenants in there, it's difficult for us to make an accurate estimation as to when those commercial tenants are going to reopen. So we want to structure interest reserve, much like Craig is saying on his deal. It's like we want to see 12 months of interest reserve, because even if they open up the markets a month from now, the possibility that there's a resurgence in the virus and go back to lockdown certainly exists. I mean, I think we're seeing that in some countries in Europe. So we want to make sure that any loan that we structure today has enough built-in reserves to weather the existing storm.
Right. Yeah, no, I think it's really important. You know, a lot of people think in the moment, right? And say, okay, well today, you know, yes, my commercial tenants are not there, but obviously they'll come back, they'll open, they'll go out for business again. But, you know, globally across the country, there's a lot of retail tenants, mom and pops, or just companies that are not super well capitalized. And the question is, will the government initiatives, specifically, you know, the SBA programs, be able to prop up these companies to a point where they'll be able to reopen after this? Will they be able to buy inventory? Will they be able to continue their lease payments? And that's something that the balance sheet lenders are really trying to focus on, the banks. Will these retail tenants even be open in November or December, right? After the stay-at-home orders are gone, hopefully. So there's interesting implications to these, like I said, across the whole real estate industry. It's funny, I just got a term sheet on a deal. It's an 8/2 mixed use property. I haven't even shown the client this, so if he's listening, he's going to get a good phone call after this. It's an 8/2. It's not essential retail on grade. It's a barbershop and a screen printing store, I believe. And we made an agreement with the lender that they will close the loan underwriting the commercial income as long as those commercial tenants are open at close, right? So, and if they're not, then we're gonna obviously structure an escrow or a reserve up to a certain magnitude of months of principal interest, and maybe some carrying costs. But the point is, there are still banks aggressively lending. I've found success with the banks, kind of not the household names, the banks that typically were not competitive in a normal course of business cycle, and that are now seeing a lot of deposits on their balance sheet and say, let me go grab some commercial real estate business. Let me go compete for this in a competitive set that is not as big as it once was. And maybe I'll be able to get some good clients at the bank, some new clients at the bank, get some good operating commercial real estate in some good locations with good sponsors. And those are the banks that we've had success with in structuring these deals as this kind of matures through the through the economy. So let's pivot a little bit. We have a lot of topics to cover. So this one's to all three of you. You know, in March, it was very questionable. And Jim, I know I called you out of nowhere about logistics. How are loans getting closed, right? Are people showing up to closing tables anymore? What's the alternative? How are title reports getting done? Are they getting done with, are they happening slower if the municipalities are closed? I know there's a broad question. So Jim, just kind of chime in where you see fit.
Well, we see mainly escrow closings, which hasn't changed much in the past few years. They've all been escrow closings for commercial. On the residential side, we're seeing many more escrow than we ever did before. But predominantly, we expect that will go back to normal when they have to sit downs. But for commercial transactions, all have been and all will continue to be escrow closings. We are having some slowdowns. I know you mentioned that with searching the public record. New York City, the county clerks are all closed. So we're unable to get mechanics liens. We're unable to get lis pendens. We're unable to search surrogate court. So depending on the transaction, we have to be flexible. We have to do things that we probably haven't done in the past to help get deals done. We've been covering the gap period, that quote gap period, from the time of our last search to the date of the closing. We've been trying to cover that as much as possible in an indemnity agreement. Typically, in an acquisition, the seller will have to look at the seller hard and see, is the seller creditworthy? I mean, this is something we never did before. We never had to really look at credit underwriting in the context of title insurance, absent mezzanine, non-imputation stuff. But now we're doing it because we want to get to the closing table. We want to know that if there's a mechanics lien out there or some lien that's about to hit that we can't get because we're unable to search the public record, that we have some backstop. And we haven't been getting much pushback. Sellers have been good about it because it's their lien. We would have found it but for the county being closed. So it seems to be keeping the wheels moving. With respect to loans, getting them closed, obviously we have a problem in the area of building loans. We can't file building loan agreements. And if we can't file a building loan agreement, we can't get the mortgage recorded because it has to be filed before the mortgage gets recorded.
Right.
So
that's a really
that's been tricky.
So simplify a building loan agreement. When does a building loan agreement come into play? What specific loans require that every single time?
So any loan where there's future advances for hard costs. So the loan agreement, the building loan agreement will get filed at the county clerk. It's signed by the borrower, it's signed by the lender. It puts obligations on the lender to fund under certain circumstances. It tells the borrower how much money is available for cost of the improvement that's available to contractors.
Right.
That building loan agreement must be filed before the mortgage is recorded, or a mechanic will come in and prime the mortgage. And that's a huge risk for us, a risk for any lender. So it's been difficult to get a brand new construction loan done. We've been working on them though. We have some thoughts and some ideas, and we have actually been able to get a few done.
Right.
Not by filing the building loan. We've been able to get indemnities and no fundings up front.
Right. So as the lender, Mark, are you looking at, I know you had a pipeline call yesterday with your team. Are you looking at construction loan opportunities given what Jim just said with the implications that you might not get a totally clean title report?
No, we're not. I mean, we wouldn't want to close, and certainly we wouldn't want to advance on a building loan agreement without a recorded mortgage. I mean, Emerald Creek has never been a huge construction lender to start with. It makes up less than 10% of our portfolio. And I would say now that it's construction, unless it's for a health-related use, it's really non-essential. All the projects, are on hold right now. So the timeline is a bit uncertain as to when those projects can get started. So we're definitely not focusing on construction right now.
Yeah, I actually had a closing that was scheduled for April that we teed up back in February for a condo conversion in Brooklyn, and the moratorium came down. The borrower just called me like, "Hey guys, you see the news?" And we're like, "Yeah, we saw it. So can we close in May?" "Yeah, no problem. We can close in May." So it's definitely something that people that are active in the construction space or anything with a hard cost holdback, right, is definitely going to have implications to this while the municipalities are closed, right? So it's definitely something to be wary of.
Look, I think lenders are going to be understanding to that timeline. I know we certainly are. We've had our borrowers on those deals that do have future advances call us, ask for some flexibility on the maturity schedule. So, in those instances, we're certainly going to be flexible and understanding and provide extensions when needed.
And so go for it.
Yeah, no, I was just going to chime in as counsel to borrowers, we're sort of at the mercy of the banks and the title companies. I mean, in terms of closings during this time period, we're doing what we have to do to get deals closed. So I say, point that we're closing an escrow on commercial all the time. It's sort of it's escrow with a twist. If we need to meet in a parking lot or meet in an open space where we can put the documents down in one place and have a notary do it in another space, we're doing it. I'm seeing it. I'm talking about it with my team, on a regular basis of how to get it done. The interesting piece is a lot of people have sort of gone off to their special places in other states. And so it makes it difficult to get documents notarized or even signed and then back. And having to, I mean, the governor had an executive order that allows for remote and audio-visual notarization of documents, which I'm sure everybody's familiar with. But you need to know that the borrower themselves are actually, or the person signing the documents are actually in New York State, which is something that's got lost, and it's important. So actually had to have someone cross state lines to be actually physically in the state while they audio-visual for real with the person. You have to comply with it. I'm sure that title will certainly back up here and say absolutely. But we're doing what we need to do to get deals closed. I always tell my kids this, for preparation is the key to success. Well, even more so with these closings. I've started on closings that I'm looking to close on the 27th, 28th, 29th of this month. We started a week and a half ago, generating doc circulation, things of that nature for execution and notarization.
I signed loan documents on my attorney's front lawn 2 weeks ago.
There you go.
Craig, have you actually done a parking lot closing?
So I personally am still in quarantine. I'm hoping after this long to go get a test and come back with a negative and be good to go. And then I will be happy to go wherever my clients need me to go to get documents signed and notarized.
I love it. I love it. I love it. Look, I really like what you said. I have a couple closings scheduled for the end of April. And even before the loan was committed, I was talking to the bank and I was telling, my originator, get guidelines from your attorney on closing procedures, because if they've changed for any magnitude, I need to know, and I need to talk to my client, the borrower, to see if we're okay with that. And specifically, I had a client, I didn't place this loan, but I know it just closed last week, but he lives in Cleveland, and the bank was saying that he had to fly into New York City, and he's like, I'm not getting on a plane to right now to close this loan. So, that was something that pushed back the closing. But if it was addressed earlier in the normal course of time, then it would have been, handled. So to anyone who's watching, speak to your broker, your attorney, your lender, if you're going direct, and have these conversations. Really ask the questions on how we're going to close this loan, even as simple as a question as that may be. You may be surprised. So, these are all really good items. Anything else that we left out?
I think you touched on, I'm sorry, Craig. I think you touched on the remote notaries. We haven't been seeing as many as you would think, because the logistics behind it are very hard. You need to have a webcam, you need to have the right software, you need to have a scanner. The borrower has to scan the document back to you at the table. By the time you coordinate all that, they're looking for another way to do it. They're looking for Craig's parking lot.
I was on a call with one of my colleagues this morning, and he actually said to me, I can't wait till there's actually the possibility of like an in-person closing. I never thought I'd say I want to go back to sit-down closings, but I want to do it because it takes a lot of effort. I mean, it does, but I mean, people are, to Mark's point, people are really working together, being really collegial and playing nicely in the sandbox to make things work, to figure out ways and being creative and doing things we may not have otherwise done before to get it done in the name of just collective goal of getting to the finish line. Matt, you mentioned earlier about the zero allocation for commercial tenants. I actually have a portfolio of loans that's closing at the end of the month, and yesterday we got a notification from the lender that they were reallocating the proceeds. They weren't taking away proceeds, but they were basically giving zero to those that had commercial with resi over, and moving it over to other properties that were just purely available. The LTVs would be acceptable to the lender.
So they just adjusted the allocated loan amount per property to kind of optically on their balance sheet just look like it's different allocations, but to the borrower it's still the same loan.
Correct.
Right. I like that. That's creative. Let's pivot again. We got a lot to get to. So let's go to Mark. I know you said you've been seeing a lot of bank quality deals, but as a lender, you kind of have to think worst case scenario always when you look at these deals. Are you back to 2010 levels of underwriting? Are you thinking worst case scenario? Are you still giving credit to business plans as people present them? How are you advising your team to, continue to keep your originations platform moving?
Yeah, it's a good question. I would say, we're not of the mindset that we were in 2010. I mean, the crisis that occurred in 08 and 09, I think it was deep. It was led by the banks. You saw bankruptcy filing by Lehman Brothers, Bear Stearns. I mean, it was everywhere. We're viewing this certainly as more of a short-term situation. I mean, relative to that one. So the opportunity sets we're seeing today are different, just by their very nature. I mean, they're not so distressed. Now, it's only been a few weeks, so obviously I think things are going to change, probably not for the better, but we were seeing a lot of foreclosure bailouts, bankruptcy bailouts, distressed, discounted note opportunities, where today the deal flows, the deals that we're seeing are mainly acquisitions, and as you said, fallouts from the banks. So they tend to be, really high quality sponsors, relative to what we're normally seeing, with really high quality assets and great locations. So although the deals have to be restructured a little bit, I mean, we're not in a 75 to 80% LTV lender anymore. So just to give you a little color on how we're thinking about structuring deals, as I mentioned, we definitely want interest reserve to create a cushion and help weather this storm. But we also are looking for personal guarantees on just about every transaction. I used to give in on a pledge. So, originally we were requiring 100% pledge of the membership interest from the borrowing entity in 2010, 11, 12. Then a lot of competition came into the space. We had to compete for the good deals. So oftentimes we'd negotiate perhaps the PG out of the deal or give up on the pledge or a percentage of the pledge. Today, we want personal guarantees. We want a pledge of the membership interest of the borrowing entity. We want that interest reserve. And, if there's competition out there that's saying, we don't need the personal guarantee, then for us, it's like, we'll just pass. I mean, there's a lot of uncertainty in the world today. And I think, as I mentioned to you yesterday, it's like, we have 4 dedicated active discretionary funds. We speak to our investor base every day. They're all telling us, listen, if you don't originate any new deals over the next 3 or 4 months, that's okay with us, right? So I'm not doing anything wrong by not closing deals. Whereas, 1-2 years ago, it was definitely origination mode, closing mode. Today, it's, look, if there's a good deal, we like it, we'll put out a quote that we're comfortable with, but we're not going to have a race to the bottom like we were 2 months ago. Things have changed.
Right. No, I think that's really important what you said. One thing I like working with you guys is that, I have complete confidence in certainty of execution when I get a term sheet from Emerald Creek Capital. I know your money is discretionary. You've raised the fund, you closed it. It is what it is. There are certain bridge lenders out there that have, come up as you said, made the space very crowded, who raise capital different ways. And a borrower might not know the difference or might not see the difference until it's too late. There are some funds out there who kind of pass around a hat, so to speak, have a crowd of investors and everyone chips in $100,000 into a $10 million bridge loan. But that really gives, there's a lot of risk into that, because a bridge loan typically has some kind of time of the essence to it, right? So you want to be wary of who you're actually getting into bed with, and make sure, ask the tough question in this time, especially if your bank just fell out on you. You do not want your bridge lender to do the same because they couldn't raise, what is their component of the capital stack from their crowd of investors. So, again, to anyone watching, ask your broker, ask your lender, how are you capitalized, and, wait for the right answer. If you are not satisfied, speak to somebody like me, an intermediary, or somebody else in the space who will say, who are the guys who can give me certainty of execution? We had a loan in the Midwest, a very, very good positioned retail shopping center. It's it actually has the only Starbucks within like a 50-mile radius, which I know for us in New York is crazy. There's one on every block. But yeah, there are markets with Starbucks, that scarce. And we signed it up with the lender. We're about to order third-party reports, and the lender called us up and said, sorry, this is around like the middle of March. We're just not lending right now. We'll refund your entire good faith deposit, but unfortunately, you're going to have to find financing somewhere else. And that's very tough. This was, the borrower was in hard contract, non-refundable by about 200 grand. There was an inflection point in his thought process. Do I lose my deposit, which many people had that same thought process in March, or do I try to find financing elsewhere? And luckily, we were able to, find a bridge lender to match the same level of proceeds as the bank, which was 80% loan to value on this acquisition. But ultimately, they found the merits in the deal. They saw that the tenancy was strong, the demand drivers were there in the market, and we were able to put in place this financing to close on the acquisition. The borrower had to extend the contract by a month, and it cost them another 300 grand, but we gave them certainty. And so I think that's really important as, the market kind of moves as we go through this, through the virus. So it's interesting. Let's figure out a new topic. Construction, moratorium. We're hitting a lot. We're moving fast, guys. Oh, here's a good one. Craig, DHCRs. The utmost, how big of an implication these are, these documents. If anyone doesn't know, a DHCR document is it's a rent roll that you have to give to the city of New York to tell them where your rents are, your legal registered rents for rent stabilized units and rent controlled units. This piece of diligence is paramount in an acquisition, but right now the DHCR office is closed. So Craig, if you had a client in acquisition right now who either they're in hard contract, how are you advising them to handle diligence? A lot of banks, Mark, will go to you next, they require inspections, appraisals, third-party reports. If no one can get into these buildings, if you can't complete your normal course of business, well, how do you handle that?
So DHCR reports, the registrations you're able to get them. You have to do it through the mail right now. So it does take time. So it's not as efficient as it normally is, where you just get the letter of authorization from the owner. You can go down, get it at Gertz and pick it up, and you have your report 24 hours later. It takes time. We found that diligence projects, both on the acquisition and on the lending side for lenders that are making multi-loans still are right now, we're able to do our diligence remotely. In fact, the good thing that's come with technology, the Dropbox and the Box or whatever whatever system you're using, is that we've actually been able to do it more efficiently. A lot of owners have started to digitize their files, which has made it a lot simpler, and in a strange way it cuts down on it enables social distancing. So we're able to get the files, review them, and then come back. Our administrative teams at Belkin, we do this every day. We're capable of doing it online, coming back, putting out whatever documents we're missing. I actually have an acquisition that's going on right now. It was paused for a moment and now back because part of it was that the owner did not have all of the records with them in their management office. They were in storage. So getting them back from storage was obviously a big piece. They didn't say no. They said, sure, we'll get them for you. But they just came back and said, we have 12 boxes. We cannot digitize these. Can we figure out a way for you to get them somehow to be reviewed? Haven't spoken to my partner just yet as to how we're going to do it. But one of the things that was put out there is the owner said, I have a garage, it's a 3-bay garage. I'm happy for them to come to my home and spend the day in my garage and go through the files and do what they want, or to come pick it up and do whatever they want. So again, people are being open-minded and creative in how we can get these deals done, or try to get deals done. Now, there aren't many deals there aren't many new deals that I've seen that are going on. It happens to be that this deal had started before, was put on pause for the diligence, and now is picking up again. So I'm grateful to have that deal in the pipeline. But I think that's how that type of review is going to take place. And if there's any benefit from COVID, it's taught us that we can do a lot of different tasks with the use of technology. There's some good, there's some bad with it, but this is one of the good things.
Right. Parking lots and garages. I'm excited to see like what's gonna come next. All right, so that's good to see that diligence is still moving. Mark, on the third party report side, are you giving appraisers a little bit of leeway as far as what they can inspect? I know I have my own experiences on deals on appraisers that went through my buildings in March, but are you giving that flexibility?
We are. I mean, we had a deal sign up last week in Brooklyn. I called the appraiser. He's looking for work, but I'm not going to ask an appraiser right now. It's not a large loan. It's a mixed use ground floor retail with 4 units above it, residential. I'm not going to ask him to do an interior inspection, and I'm pretty sure the tenants aren't going to open the doors for him. So we're in that particular instance, there's a prior appraisal that has interior photos. We're going to ask for maybe a little bit more documentation. So we're going to want to see bank statements illustrating, the revenue coming in, that it is stabilized. We might want to see the tax returns of the operating company to see that the revenue and net profits are there. And then as it relates to the appraiser, he's going to do an exterior inspection. They'll probably make an extraordinary assumption that it is stabilized as represented, but we are being more flexible where we can be. But I mean, I suppose that there are certain asset classes that, if we can't get inside, it's going to be really difficult for us to get comfortable with the underwriting. Because normally we have our third parties inspect the interiors, and then somebody from Emerald Creek goes, also does an inspection of the interiors, the roof, the mechanics. So it certainly has become more challenging. Where we can be flexible, we're trying to be.
Mm-hmm. Anecdotally, on the loan that I mentioned earlier, they asked a number of tenants to take actual videos of their units, their apartments, to give to the appraisers, and that's how they did the internal inspection.
Interesting. Yeah, look, I think on my end, no bank, no originator, no bank president wants to be the guy or woman who's, telling their staff or third party, inspectors to go into someone's unit and potentially get the virus, right? No one wants to do that. So I've definitely seen a great deal of flexibility to an extent. Obviously, no one's waiving appraisal requirements, but I had an appraisal for a package of condos actually right next to the Elmhurst Hospital in Queens. And the appraiser was like, listen, I couldn't get into this tenant. I couldn't get into this tenant, but I peered through the windows. I mean, there's clearly things there. Maybe I just went at a bad time of the day. But I'm just going to put that in my report. And we should be getting a commitment letter this week on that deal. And I haven't heard anything from the bank as far as that the appraiser has to go back, right? So fortunately, that's going to work out. So it's nice, I had another thought on my mind as far as that. Bank statements. Mark, you mentioned bank statements. Going back to the commercial underwriting, every lender right now is very worried about collections. And in fact, many of the banks that have pulled out of the space temporarily are doing so just because they don't know how to underwrite collection loss. In New York City, again, we are all lucky to have one of the strongest markets, in the country, and typical collection loss in stronger parts of Manhattan are, under 3%, in the Bronx, maybe 5 to 7. But right now, without any precedent, right, this is a 1 in 100-year phenomenon, banks don't know how to underwrite what they don't know, right? So bank statements are becoming paramount as another part of diligence to underwrite these deals. And if a borrower shows a bank statement where they're not collecting the full rent roll, or even the rent roll within the certain margin of error that the bank allows, that loan will get cut. There's really no two ways about it. It's very binary. the last thing a lender wants to do in this time is to originate a loan that will either have to go into forbearance a month later or technical default, right? No one wants to do that. And so, this is something that while borrowers may be, it might be annoying for them, as we've been very privileged this whole cycle with very aggressive financing assumptions, things are going to have to take a change for the time being. And we all have to kind of adjust to the new norm, right? So it's, it's a really interesting way of handling things.
Yeah, I think, part of the way to alleviate, that scenario is create a big buffer of interest reserve to weather the storm. We have some deals right now that we're underwriting that, are in lease up mode. So they're 30% occupied, new product, need to get leased up. We're probably going to input higher vacancy rate and a slower absorption. But I think there was an article that Related came out yesterday and said they collected maybe 30 or 35% of the rents, residential rents. I think only like 20% of commercial tenants are paying their rents right now. So, I don't think that's a forever thing. So, for us, it's if we can buy a year of interest payments, we're going to make the bet that the world comes back. Otherwise, I think we all have bigger problems.
Mm-hmm. Yeah, no, I think that was really well said. Let's talk rates for a little bit. I've had a lot of questions from clients of mine earlier in March as to, well, the Federal Reserve lowered the federal funds rate to 0. Why are interest rates not free? Like, why am I not getting the benefit of this? And, I think, it's a very interesting question, because dynamically you think that's the relationship, and loosely most of the time it is. But, a lender, Mark, there's your index and then there's your spread, and your spread is really your estimation of risk and profit margin. So, Mark, have you seen your spreads increase in March? And if so, by what magnitude?
Well, I mean, we use a little bit of leverage. So we borrow from the banks on a very small scale. I mean, we have a portfolio of 100 loans. We're maybe borrow 10% of the money we have on the street right now might be bank debt. 90% is LP equity. So we're in a very strong position from that matter. The way we price deals, frankly, is 100% related to the risk we see. So even if rates continue to go down, we see more risk in the world today, and so we're going to be pricing it accordingly. If our lowest rate was L500 2 months ago, today it's probably L600 would be our lowest. It's just and a lot of it depends on location, the asset class. We're going to make an estimate as to what do these tenants look like in what might be the new normal, and when do we think they'll come back. We've always been pretty wary of retail in general, certainly big box, but I think all aspects of retail has obviously taken a massive hit over the past couple of years, mainly due to the Amazon effect. I think it's really just going to get worse, in the foreseeable future.
Craig, on your Freddie deal, is that conventional or is this small balance loan?
It's conventional.
Have you guys rate locked, or is that coming up?
Yes, they rate locked, so that's why we're closing at the end of the month.
Right, good. Yeah, I had a deal that it's a swap deal with a large national bank for a very well positioned, fully occupied elevator building in Harlem, new construction, and we priced this at it was at the bottom about 2.15. But the lender had to, because of the dynamics of a swap contract, the lender had to actually reprice that because of what's going on in the economy. Like, their spread had adjusted mid underwriting. So we're actually about 2.65 right now for a multifamily deal, and that will close next week, fortunately. But the borrowers, if they're listening, they were a little bummed out that it's not 215 anymore, it's 265. So it's funny, but one of the things that the lender brought up was the liquidity premium, which is something that investors or institutions require as a premium to their kind of their spread for lending or investing into an illiquid asset, which in real estate is inherently is. And, again, we're in New York, something can sell in 30 days, but in most markets, you need 6 months to sell a building, right? So, it's tough, and that's definitely been some of the reasons that we've seen spreads increasing. So it's just an interesting case study. Craig, do you have any CMBS deals on your plate right now?
Not right now. So I don't have anything I could speak of in the pipeline right now. But I can't imagine they're moving very quickly.
They're going nowhere fast. To just talk about CMBS quickly, it's a huge outlet of credit towards commercial real estate, and they are essentially all paused right now. Deals that were closed and securitized really had trouble being sold to bond investors in the past 30, 45 days. The spread over what an investor's risk-free rate, the 10-year treasury, so to speak, blew out in between that loan closing and them actually buying the bond. And so there was this kind of dislocation in price between what the end user, the bond investor, wanted and where the originators were pricing these loans. Once a loan closes or rate locks, there's really nothing you can do about it, right? So, those deals are kind of just, sitting on the shelf. I know the Fed and the Treasury injected some capital to kind of move deals along that were securitized before March 23rd, I believe, which will help. But that machine is definitely, on pause for some of the fundamental reasons that we mentioned. They just can't underwrite. They just can't underwrite collection loss like every other bank. But they're having difficulties pricing deals as well, right? They can't honor a spread week to week. And, a lot of these guys' reputation means a lot to them. I think it means a lot to all of us, right? And, they don't want to really put a spread on a piece of paper and then just say, hey, market took another turn, we're going to have to change that. Well, what good is it putting on a piece of paper anyway, when you to start? So, I do think, Wall Street has always been an institution or a body that's always had really good efficiency with finding opportunities when there's dislocations in price. So I do feel confident that will start to be another outlet for borrowers as we go forward. But, as for right now, and specifically, about an hour ago where I just checked in with one of my lenders to make sure I wasn't missing anything, it's definitely, a little wait and see moment. So, if you have deals nationally where CMBS was your go-to outlet, what I would recommend is, speak to your broker, speak to your go-to lender, and kind of figure out where they are in their underwriting. There's nothing bad with exposing your deal early. And that's really something I'm telling my clients across the board, is that even if you have time until your maturity or your balloon later in the year, let's start today. Let's figure out who's going to be active, who's going to bid aggressively, who wants to wait another month, and let's get all this information at our fingertips so that we're not rushing to it sometime in, the latter parts of the year. And that goes for CMBS lenders as well. Figure out where they are. And when things do return back to normal, you will be at the front of the queue. With the lack of lending that's available right now, when things do return back to normal, there will be a massive wave of originations that happen. And the last thing that you want to do with a borrower, as you have to do something, is be in the back of that line. So, I think that's something very, very important to those who are trying to figure out the rest of their year. Definitely plan these things out a little bit more efficiently. Craig, here's a good question. Loan workouts. I'm sure you got a lot of questions from your borrowers on loan workouts. How are you advising them on how to handle their tenants, for one, and their lenders on the other hand, right? I know you have really good relationships with, the top lenders in the city. What are they giving, and how are you advising borrowers to go get relief if they need it?
So, in mid-March, I was asked by someone to what lenders were doing. And I said, well, it's only March 15th or 17th or 18th, whatever it was. I said, let's see what April 1st brings. April 1st actually proved to be okay for owners. They got,
right. It definitely was.
Residential tenants, from what I spoke to my clients and just polling owners, whoever I was speaking to, if they got their rents, it was pretty much like 85 to 90% of that rent was collected, which is pretty good. So, I mean, and I the corollary to that is speaking to the lenders. Lenders said that they were happy to see that they got the majority of their April mortgage payments, and they expected them in full, principally because mortgages are paid in arrears. So really, the March rents were paying for April's mortgages. So now, come April, lenders are saying, if you have issues with your rent roll, if you're not collecting rents, they are open to forbearance in some form. A lot of the lenders that I've spoken to and a lot of the situations that I've guided clients through have been that they're open to the fact that pay your interest and your reserves, and they'll push off the principal payments towards the back end of the loans or over the course of the loans, and they'll get paid at that time. There's no penalty for it. You're not going to get late penalties for it. We'll just forbear that. Question that comes after that is, well, will that affect me moving forward? I'll pose that question to Mark as the lender, as to whether or not it would matter to him if someone entered into a forbearance. I don't view that, given the circumstances. As counsel, I would argue that they should be given the benefit of the doubt in this situation, as long as they continue to make those interest payments and they stay current on those forbearance agreement. I view that more as just simply a modification of the loan terms that's agreed to between the parties, with no harm, no foul, because everyone's happier if we're getting something rather than nothing. I don't know if you want me to answer the part about what I'm guiding owners on in terms of how to deal with their commercial tenants, or vice versa, commercial tenants that may have called us as it relates to their, whether or not to pay their rents. I could, I'm curious to see what Mark would say about.
So Mark, if a borrower comes to you with some kind of blight on their credit record, or say they just forbore, I don't know if that's the present tense of that word, but if they did that, what's your take? How do you handle that?
Look, I mean, we're going to be understanding. I mean, the world is upside down. People, tenants, commercial tenants are legally, they're not allowed to open up their storefronts. So things are going to be dislocated, and I get that. It's very similar, in 2015, 16, when we're underwriting loans and underwriting the sponsor, and I see, he had 2 foreclosures in 2009, and this guy's a real estate guy, and he had a lot of development sites, and the bank stopped lending. It was impossible to get a refinance. So I was understandable about that situation, and we'd certainly be understandable given this situation. So we have currently, just to give you a little bit about our active portfolio, and we have roughly 100 loans in our active portfolio. We have received the April 1 payment for March's interest from roughly 95% of our book. So we feel very good about that. Now, I think, potentially could get worse next month. But on that other 5%, I've communicated with all the borrowers. We have modified those loans to allow for partial relief. Because look, if it's a retail strip center and every single store is closed and he's not collecting rent, I get it. It's going to be really hard for him to pay his interest. So, I'm not super inclined to be like, okay, you don't have to make any interest payments. I mean, they can provide a small portion of that interest payment. And what we've done is, I haven't done it on a 1-month basis, because I don't expect the situation to immediately resolve itself in the next 30 days. So we've primarily done 90-day modifications, where we allow the borrower to make a partial payment of the interest, and the balance is deferred for a later time.
Right. And Craig, you mentioned so let's keep the point of view from borrowers, right? So how are you, or landlords, how are you advising landlords to deal with tenants who might be on the cusp of non-payment or asking for relief? Is there a rule of thumb to go by?
So, I mean, as far as owners are concerned, we're basically telling them that obviously lenders, and you have to look at your building on, every building in your portfolio on a case-by-case basis. Depending on the makeup of your building will dictate, whether or not you're going to seem sympathetic to a lender, and also sympathetic to, and in terms of vice versa, in terms of your own tenants, how sympathetic you're going to be to your tenant who's saying they can't pay. You can't just say, someone can't say, well, I don't want to pay rent anymore, right? I mean, that's a situation that we're seeing, where initially clients were fearful that people weren't going to pay their rent, and just say, well, COVID happened, so I don't have to pay my rent, which was the whole, where I think the governor's done a really good job. He said, listen, we've put a moratorium on evictions. There's nobody getting kicked out of their place, but we're not going to say your rent isn't due. What we're guiding our owners to do is, on the commercial space, speak with your tenants on a case-by-case basis. If they have the capacity, if they're willing, and you could come up with an agreement to access their security deposit to cover the rents for a period of time and deferring it out and replenishing those, we're doing those types of agreements. We're also doing straight deferrals. We were contacted by a commercial tenant, Madison Avenue, relatively good amount of term left on their lease. Said that they went to their owner and said, we're not essential. We're not going to be open for a month, 2 months, 3 months. We want a break in our rents, and they gave them percentages. The owner came back and said, nope, no breaks, no nothing. Your rent is due. What do you tell a commercial tenant like that other than to say, do you have a good guy guarantee? Do you have the liquidity to make your payments? Tender the notice. I mean, nobody wants to do that. That's not the type of cycle. So when they did that, sure enough, the owner came back and said, fine. And then they started to negotiate. So it's, again, every owner and, is going to be different. But I think that you just need to sort of get to the point where people are open to having a conversation and working together to come up with a payment schedule that will work in the long run for everybody.
Can landlords dip into security deposits to pay to kind of collect rent in the interim? Is that allowed?
If you, by agreement, you can. I mean, you can do that, and people are doing that. And people are going to replenish them down the line. So yes.
Right. Yeah. No, it's interesting. I have another client on Madison Avenue and on the Upper East Side. It's an office over retail building, and you can imagine the headache he's having with his tenants on who's paying on time, who can pay how much, and the one thing he said, which I think was really, which meant a lot, was, it's a family-owned asset. We have relationships with all our tenants, right? Just like banks have relationships with all their borrowers, right? We don't want to penalize someone who's been a very good paying tenant because of this, like I said, once in 100-year phenomenon. So, he's kind of skirting the line between, asset manager and, human, right? To kind of be everyone's friend. But at the end of the day, he has to do what he has to do. And the security deposit was that was his solution. So yeah. Craig, we spoke about this yesterday, and you said it's something really loose. Is force majeure something that people can use to kind of get out of contracts or renegotiate their leases? I know the answer, but have you seen success in it?
Have I seen success in it? I haven't seen success in it. The interesting thing is, first you have to see if the document actually has a force majeure clause in it, because not every contract has it in it. Most loans do. I have seen expansion of force majeure language in loan docs, specifically on some of the deals we were talking about, that have now been expanded to include the pandemic, to include governmental shutdown, to include COVID-related, covenants and concepts into force majeure. And I think obviously they're here to stay. Every clause in a loan document exists because something happened that caused it to exist. Similarly here, again, force majeure doesn't forgive your obligation to pay. It may stall or delay or give you rights to not have to reach a certain, do a certain covenant or make a certain covenant.
Complete an obligation.
Complete an obligation, but it's not. It's again, I don't believe that this. The other thing is it has to be an act of God, right? Is this an act of God, or this was a governmental shutdown, right?
That was your answer yesterday. I thought this was, but you're right. Government shutdown. This is man-made. So it's interesting. Thanks for that answer. All right. So it is 3:00. 60 minutes flew by. I want to say, I want to say thanks to Craig, Jim, and Mark. Thanks for taking your time today and yesterday to coordinate this. Thanks to AmTrust for putting us all up here. If there's anyone watching who wants to continue the conversation, I'm sure our friends at AmTrust can coordinate that either between Mark, Jim, myself, or Craig. And for that, I'll say thanks. We appreciate it. Talk soon.
Thank you.
Thanks, Matt.